you were told the Epstein files were about politics, celebrities, and scandal. That's convenient. What almost nobody mentioned is the money. Buried inside millions of pages is something far less sensational and far more revealing: a private financial email about silver, delivery mechanics, and market structure written in 2011. Not gossip, not speculation, a calculated market thesis. While the world argued over headlines, sophisticated capital was studying how to pressure a global commodity market. So here's the uncomfortable question: were the loudest stories a distraction from the quiet ones? Today, we're not chasing names. We're following the documents, the trades, and the structure behind the silver market. In 2026, millions of pages connected to Jeffrey Epstein were released into the public record. The public conversation immediately centered on familiar themes: powerful names, private travel, criminal proceedings. That focus was predictable. What went largely unnoticed were the financial documents embedded in the archive bank correspondence, portfolio statements, advisory communications. These records were not sensational, but they were revealing. Among them is a dated email from May 27, 2011. It was written by a private banker and sent directly to Epstein. The subject line referenced power of attorney and silver. The tone was professional and procedural. The banker explained that he was transitioning roles and required updated authorization to continue managing accounts. Attached to the message was research on the silver market. The substance of that research is what matters. The banker argued that a squeeze in silver was structurally possible if market participants demanded physical delivery of futures contracts rather than settling in cash. Most commodity futures are never delivered. They are closed or rolled forward before expiration. Exchanges function efficiently because only a small fraction of contract holders request actual metal. The email identified this as a vulnerability. Earlier in 2011, silver had surged toward $50 per ounce before falling sharply. The decline followed a series of margin increases imposed by the exchange. Public commentary framed the episode as speculative excess, collapsing under its own weight. The private analysis took a different view. It described margin hikes as a mechanical tool that forced leveraged traders out of positions without necessarily resolving underlying supply pressures. The distinction is critical. A margin increase does not create new silver. It changes financing conditions. If the fundamental balance between supply and demand remains tight, forced liquidation can suppress price temporarily without altering structural constraints. The research reportedly included references to exchange position limits and delivery procedures. This was not promotional language, it was technical. The focus was on how the market actually clears, how contracts convert into metal, how inventory is categorized, how leverage amplifies volatility. The importance of this document is not tied to personality or scandal. It is tied to mindset. It demonstrates that by 2011, certain private wealth circles were evaluating silver as a market shaped by structural mechanics, rather than short-term sentiment. At the time, that perspective was not dominant. Most mainstream analysis treated silver as a volatile trade driven by retail enthusiasm and inflation fear. Few discussed delivery stress or exchange inventory in detail. Yet inside a private advisory relationship, those mechanics were being studied carefully. The email does not claim certainty. It does not predict a date. It outlines conditions under which pressure could build. Physical delivery was identified as the catalyst. Margin policy was identified as the counterweight. Supply constraints were treated as foundational. That framework becomes more significant when viewed in hindsight. It raises a question that extends beyond a single correspondence. If sophisticated capital was analyzing silver through structural mechanics 15 years ago, what has changed in the underlying system since then, and what has remained constant? That is where this examination begins. 5 months before that email was sent, another document was created. It was a portfolio statement from JPMorgan Chase. The account holder was Ghislaine Maxwell. The statement recorded purchases of shares in a publicly traded silver mining company during late 2010. The transactions were direct equity positions, not broad commodity exposure through diversified funds. The company's revenues were closely tied to silver production. The timing coincided with the period leading into silver's 2011 surge. On its own, this information proves nothing beyond investment allocation. Investors buy commodity-linked equities for a range of reasons: hedging inflation, seeking leverage to metal prices, or diversifying portfolios. However, When placed alongside a detailed silver thesis circulating within the same financial orbit, the timing becomes relevant. It suggests that silver was being treated as a serious strategic asset within that circle, not as a passing speculation. Another historical development adds context. In 2020, JPMorgan Chase paid substantial penalties related to precious metals market manipulation. Traders were convicted of spoofing, placing orders they intended to cancel to influence price direction. The misconduct affected gold and silver futures markets over multiple years. This legal outcome established a fact. Silver pricing during that period was not always a pure reflection of organic supply and demand. Artificial distortions occurred. That does not imply coordination with any individual investor. It does demonstrate that structural pressures in the silver market were interacting with complex institutional behavior. When these elements are considered together, the picture becomes more nuanced. A private banker outlines a thesis centered on delivery mechanics. A close associate within the same financial network holds significant silver-linked equivalent exposure. The primary bank involved later faces penalties for manipulating precious metals markets. None of these facts alone determine intent or outcome. They do reveal that silver, during that period, sat at the intersection of private wealth, strategy, and institutional trading practices. The broader implication is structural. Silver is both a financial instrument and an industrial commodity. It trades in futures markets, where leverage magnifies movement, yet it is physically consumed in real-world production. That dual identity makes it sensitive to both financial engineering and tangible supply. The documents show that sophisticated participants were aware of this tension. They were examining not only price trends, but the mechanics beneath them: inventory, classifications, delivery obligations, and margin rules. The significance lies not in accusation, but in awareness. The silver market was more structurally complex than public narratives suggested. It was shaped by leverage, policy decisions, and institutional behavior operating simultaneously. The key question then becomes whether those structural characteristics have intensified in the years since. To evaluate whether the 2011 thesis retains relevance, the structure of the silver market must be examined in detail. Silver trades primarily through futures contracts and physical spot transactions. Futures allow participants to agree on a price today for delivery at a later date. In practice, the overwhelming majority of contracts are offset before expiration. Only a small fraction result in actual metal changing hands. This system functions because trust and inventory classifications support it. Exchanges categorize silver as eligible or registered. Registered metal is available for delivery against futures contracts. Eligible metal meets standards but is not necessarily committed to settlement. The distinction matters during periods of elevated delivery demand. The 2011 analysis identified this as a pressure point. If a large share of contract holders chose delivery simultaneously, registered inventories could tighten quickly. Since then, global silver demand has evolved. Industrial consumption has expanded through solar energy, electric vehicles, semiconductors, telecommunications equipment, and medical technology. Silver's conductivity and durability make it difficult to substitute in many applications. Unlike gold, much of the silver used industrially is not economically recoverable at scale. It disperses into products. Mine supply, by contrast, has grown more slowly. Major discoveries are rare. Permitting processes are longer. Political risk affects production in key regions. As a result, the market has experienced recurring annual deficits, where total demand exceeds newly mined supply. Deficits are met through above-ground inventories and recycling. Over time, sustained deficits reduce available stockpiles. When inventories decline, sensitivity increases. Lease rates, the cost of borrowing physical metal, tend to rise when supply tightens. Forward curves can move into backwardation, meaning immediate delivery commands a premium over future delivery. These are mechanical signals, not speculative narratives. The interplay between paper contracts and physical supply creates inherent tension. If paper claims expand, while physical inventory remains constrained, the system relies on most participants choosing cash settlement. The more that dynamic shifts toward physical settlement, the more strain develops. The 2011 thesis centered precisely on that mechanism. What has changed since then is the scale of strategic demand. Governments increasingly classify critical minerals as essential to national security and industrial policy. Stockpiling and supply chain diversification have become priorities. These actors operate differently from leveraged traders. They secure material because it is required for production or policy objectives. Margin policy can reduce speculative excess. It cannot reduce industrial necessity. The structural framework outlined years ago remains conceptually intact. Supply, consumption, and inventory levels determine long-term equilibrium. Financial leverage amplifies volatility, but does not replace metal. The question is not whether a dramatic squeeze occurs. The question is whether sustained deficits and strategic accumulation gradually force price adjustment. That distinction separates short-term volatility from structural repricing. Silver's history provides important context for evaluating structural pressure. In 1980, the Hunt brothers attempted to accumulate large quantities of silver through futures and physical purchases. Their strategy relied heavily on borrowed capital. As prices surged, exchanges responded with higher margin requirements and position limits. Financing tightened, forced liquidation followed, and the market reversed sharply. The episode demonstrated the power of margin policy to counter leveraged concentration. A similar pattern appeared in 2011. Rapid price appreciation attracted speculative participation. Exchanges raised margin requirements multiple times within weeks. Leveraged traders reduced exposure. Prices fell. A similar pattern appeared in 2011. Rapid price appreciation attracted speculative participation. Exchanges raised margin requirements multiple times within weeks. Leveraged traders reduced exposure. Prices fell. In early 2021, retail communities attempted to trigger a silver squeeze by purchasing exchange-traded funds. The strategy emphasized paper exposure rather than coordinated physical delivery. Without substantial demand for registered inventory, the structural strain envisioned in theoretical discussions did not materialize. These episodes highlight a consistent theme: leverage-driven attempts to force price acceleration and counter institutional safeguards. Exchanges exist to maintain orderly markets. When volatility rises sharply, financing conditions adjust. A similar pattern appeared in 2011. Rapid price appreciation attracted speculative participation. Exchanges raised margin requirements multiple times within weeks. Leveraged traders reduced exposure. Prices fell. In early 2021, retail communities attempted to trigger a silver squeeze by purchasing exchange-traded funds. The strategy emphasized paper exposure rather than coordinated physical delivery. Without substantial demand for registered inventory, the structural strain envisioned in theoretical discussions did not materialize. These episodes highlight a consistent theme: leverage-driven attempts to force price acceleration and counter institutional safeguards. Exchanges exist to maintain orderly markets. When volatility rises sharply, financing conditions adjust. However, leverage is only one component of the system. Industrial consumption operates independently of speculative positioning. Manufacturers require silver for production. Governments secure strategic resources based on policy objectives. These actors are not typically compelled to liquidate during price swings. If physical demand remains persistent while mine supply growth lags, the adjustment process becomes gradual rather than explosive. Inventories tighten. Lease rates respond. Forward curves adjust. Price rises over time to balance consumption and production. The 2011 Thesis recognized margin policy as a stabilizing force. It also recognized that margin adjustments do not alter long-term supply constraints. The distinction between speculative squeezes and structural repricing is essential. The former depends on rapid concentration and leverage. The latter depends on sustained imbalance. Historical failures of leveraged squeezes do not invalidate structural tightness. They demonstrate the limits of borrowed capital as a strategy. The relevant question now is whether structural demand growth, combined with recurring deficits, can produce durable upward pressure without the need for dramatic speculative concentration. History shows that exchanges can manage leverage. It does not show that they can create supply. The documents from 2011 do not establish coordination. They do not confirm execution of a specific strategy. They do not provide a timeline for price movement. What they establish is that sophisticated financial actors were examining silver through structural mechanics well before the broader market focused on similar issues. They were analyzing delivery rules, inventory classifications, margin policy, and supply deficits. They treated silver not as a headline-driven trade, but as a system governed by physical balance and financial leverage. 15 years later, the structural variables remain central. Industrial demand has expanded meaningfully. Renewable energy infrastructure requires silver-intensive components. Semiconductor manufacturing depends on conductive materials. Medical and defense applications rely on silver's properties. These uses are functional, not discretionary. Mine supply is not accelerated at the same pace. Environmental regulation, capital discipline, and geological limits constrain expansion. Recycling contributes, but not enough to eliminate recurring deficits. When consumption exceeds new production, inventories bridge the difference. Over time, persistent deficits reduce available stock. Financial markets can obscure this dynamic temporarily. Derivatives expand exposure without immediate delivery. Margin adjustments temper volatility. Yet no financial mechanism produces additional metal. The long-term balance in any commodity market resolves through price. If supply is constrained and demand persists, price must rise sufficiently to ration consumption, encourage substitution, or incentivize new production. The 2011 framework recognized that truth. Its significance today lies not in dramatic prediction, but in disciplined analysis. It showed that beneath volatility and narrative, structural mechanics govern outcome. Silver remains a market where paper leverage and physical constraint coexist. The interaction between them determines stability. Whether repricing unfolds gradually or accelerates depends on variables still evolving. Mine output, technological demand, recycling efficiency, and policy decisions.